Yes, you're going to talk to us about the macro environment, but I think more importantly, this ECB story with an executive director resigning is, of course, one of the biggest headlines that is occurring in Europe today. Give us a sense in terms of what is happening on the ground and how big this move actually is.
Well, we've seen an awful lot of stress in markets today across Europe and Eastern Europe as well, being felt obviously in the RAN too. But I would say it came before this announcement. People have been getting increasingly worried about what will actually happen this weekend with regard to Greece, with regard to additional fiscal measures, how bailouts will occur, all that sort of thing still going on. So in a sense, I think the news that Stark has resigned is somewhat of a sideshow. His views were obviously pretty well known before. He'll be replaced with someone else, another German, obviously, who'll be equally probably as anti such sort of policies as well. So I wouldn't really say it's that much of a game changer overall.
Peter, also with regards to, again, rumours and murmurs that we could possibly see a default coming through from Europe this weekend. Do you think that's a possibility? We've got the G7 on the go as well, and that is also a very big political play, some would think.
Well, it's hard to know what exactly these rumours mean by default this weekend. I mean, it seems rather overplayed. You know, they have to miss a interest rate payment, which wouldn't happen at the weekend anyway, in order to actually default. I mean, there are some quite serious discussions going on about the triggering of default clauses within parastatal companies in Greece. But that's a slightly longer term issue, I would say, than what's going on this weekend. I mean, my view is still that we probably see some sort of disorderly unwinding of what's going on here, but that's not really a thing for this weekend. It's more into the end of this year when you have much greater funding pressure and repayment pressure. Okay,
so Peter, let's take a look at the South African economic environment. We had manufacturing numbers dismal for the month of July, down 6% year on year. The forecast, your forecast, was that it was going to be down by around 1.6%. Consensus was that it was going to shed 0.5%. So clearly very much off expectations and a very weak number. Does this signal a possible rate cut by the end of 2011?
Well, the interesting thing about the manufacturing data was really that we thought we had taken into account what was going on in terms of the strike action. It's moderately easy, we thought, to model this sort of thing from past experience, but it turned out actually the impact of the strikes were much greater, but also as well the impact of the global slowdown, loss of sentiment, and the impact that had on manufacturing and inventories in particular was much more stark than we first thought it would be. I think the trouble with reading across the MPC actually is that you have to remember the MPC itself is already much more bearish than even I think the SARB's official forecast. So in that sense, there's less room for them, or less manoeuvring they have to do to sort of readjust to what's actually coming out now. But having said that, I think the probability of cuts are rising. I think the data timing doesn't really make sense for it to happen this year, but it can happen once we reach or potentially happen once we reach the peak in CPI, and that starts falling back in Q1 next year.
Joining me on the desk in Johannesburg, our market watcher Wayne McCurry from not RMB, he's now from Momentum Asset Management. Wayne, you've got a question for Peter.
Yeah, Peter, what do you think? I mean, obviously we explained why we've had the fall in July, but do you think this is one-off, or will there be more of an impact of the global situation in next month's figures, or is this just the strike?
Well, I think actually the interesting thing is that the data can recover slightly over the next 2 months or so, according to my forecast at the moment. We can get back to around zero-ish sort of growth, but it's actually not really until you get into the October, November numbers, and which obviously come out a month later each, that actually you start seeing much more of the impact of the global slowdown. That's when we can see a string, I think, of -4%, -5% sort of manufacturing numbers. So in a sense, this is a little bit of a one-off, but the worst perhaps is still ready to come. And again, that perhaps feeds in slightly to this view that a rate cut this year perhaps isn't quite making as much sense as one potentially next year.
Let's take a look at how the South African Reserve Bank should be dealing with the currency, because now we are above that key 7 rand handle. Yes, we are still strong relative to historic numbers. And then you see the Swiss National Bank coming in and declaring that they don't want a strong currency. Tell us about how the South African Reserve Bank is going to be coping with a much stronger rand environment. And this is what many are saying, given the fact that we're still offering yield, something that a lot of countries are not offering.
Well, this is really the challenge for the SARB and for the MPC in particular, is that last time around they had the sort of global demand growth to offset the loss of competitiveness from having a strong currency. But this time around you don't have that sort of strong international position to make that sort of offsetting happen. So this time, I think the policy debate around FX is potentially more acute. Of course, remember that policy debate is dormant at the moment; it's never dead, but it is asleep. But I think it can come back into the end of this year, into next year, if we see rates on hold. We see Rand holding up pretty well overall because of that yield differential. We could well see the left in government and elsewhere starting making much more noises about more FX policy. I don't think the SARB's line changes really around that. They will still be very much anti dramatic moves, but we could well see another burst of reserve accumulation of the sort of $3-4 billion odd dollars that we saw back in sort of October, November.